Hello, welcome everyone to another session on current affairs by Civil Studies IAS Academy. In this session, we will be discussing about the Sabka Bima Subki Raia Act, which was passed by the Union government, which actually amends various insurance laws, and we will discuss the changes this will bring to the insurance governance regime in India. So this was the name of the act, Sabka Bima Subki Raia, Amendment of Insurance Laws Act. Okay, it has become an act because the president has now given the assent, right? So we will discuss how insurance, how the insurance regime was before this act, and it's actually part of, if you can link it to the main syllabus, it can be asked part of mains governance in GS2, where government policies for development of various sectors are discussed in governance. It could also be asked in social justice. It could also be asked, social justice mechanisms instituted for the welfare of various sections, right? It can also be asked in GS3, where you have the issues relating to mobilization of resources. Okay, so please understand from which part of syllabus the questions can come for mains as well. But we will also study for a prelims point of view as well. So just understand some brief facts about the insurance sector in India. They're primarily governed by three major legislations. You have the Insurance Act of 1938, you have the Life Insurance Corporation Act of 1956, and you have the Insurance Regulatory and Development Authority Act of 1999, right? So this act is an amendment. This act amends these laws. It does not repeal or any of the laws or replace any of the laws. It simply amends them. Okay, so as of now, India actually do not allow for composite licensing, right? So composite licensing is, so basically if a particular entity wants to give insurance in India, there are basically two types of sectors that it can give. It can give a general insurance or it can give a life insurance. Okay, general insurance or life insurance. So those players in the general insurance, they are actually barred from selling life insurance policies, right? So this is what we call as silo licensing, right? Okay, so the licensing, if you are a general insurer, if you got a license from the IRDAI to sell general insurance, you are only supposed to sell general insurance. You cannot sell life insurance policies. Similarly, if a life insurance insurer got a license for this life insurance, then it cannot go into the general insurance category, right? So this act, this act, one of the limitations of this amendment was that it does not allow, keep in mind, there is a huge chance for UPSC to ask and confuse you. The current amendment still do not allow composite licensing. Composite licensing means a single license. Okay, in composite licensing concept, a single license will be given to the entity and they can sell across the board. Okay, they can sell to any sector, to sell to any person. This is the composite licensing, composite. Okay, India as of now, even after this amendment, do not allow the composite licensing. So it was actually criticized. Okay, so various players said that it was a missed opportunity and like that. But anyway, composite licensing is not allowed in India even now. Okay, that's a key thing that UPSC can ask. Right, so that's briefly about the general insurance regime as of now. And the minimum capital, paid up capital that is actually required for an insurer is 100 crore. Okay, for general insurance, life insurance, any type of insurer, if you are an insurer, you need to have a minimum paid up capital of 100 crore. For reinsurers actually reinsure the insuring entity, right? So reinsurer, they need a minimum paid up capital of 200 crore. And mostly they are foreign players. It's not like Indian players are not there, but mostly they are foreign players. Okay, foreign players, right? So insuring, so if I am an insurer, I am actually exposed to certain risk, right? To underwrite that risk or to hedge that risk, I will take insurance on my liability. In case I have to pay that amount, I will take insurance on that liability with another company. Okay, that company will pay that amount. If I have to pay, if I am an insurer and if I have some liability to pay some amount, right? right, I will take an insurance on that liability itself, okay, with another player. That player is known as a reinsurer, okay, and they have a minimum paid up capital of 200 crore. This is the current, the previous regime. Now, this new regime under the Sabka Bima Subki Raia amendment, these are actually, made dynamic. That is, Insurance Regulatory Development Authority, the authority will get freedom to set the minimum paid up capital requirement for different sectors. Okay, so a dynamism has been introduced. Instead of a blanket 100 crore and 200 crore, IRDA can determine sector specific minimum paid up capital requirement. Okay, so that is also another change. So we will discuss all these changes one by one. Okay. Right, so if you look at the insurance regime, this is what I mentioned. In the Insurance Act of 1938, composite licensing is not allowed. That is silos. Okay, one player cannot go into another. General insurance is there, life insurance is there. They operate as silo, separate, exclusive sectors. Okay. Then previously the law mandates a minimum paid up capital of 100 crore. Okay, for insurers and 200 crore, which is now this is now changed. Okay. Changed. IRDA can fix sector specific limits. Okay, a dynamism has been provided. Right. This is just some important statistics and important keywords. Like for example, you need to know about insurance density. Insurance density, it is measured per annum, per capita per annum. Right. So, what is the amount paid per person? Okay, what is the amount insurance premium that one person pays in 1 year? Okay, that is insurance density, right? And India is almost like about $25. Okay, without just using normal exchange rate, it will come out to, if you use 90 or even if you use 100 rupees, it will come out to 2,500, right? 2,500 rupees. Okay, it's actually normal exchange rate. You have to use real effective exchange rate, but don't need to go into all those things. Just know that this is the the general amount that one person actually spends on the insurance premium, okay, in 1 year, okay, in India, right? Then you need to know that general insurance, if you look at the general insurance bit, that is excluding the life insurance, the sector is actually the 10th largest in the world, okay, 10th largest in the world, and it is projected to become 6th largest. Okay, general insurance excluding life insurance, it is going to become 6th largest in 2032. Okay, 2032. Right. So the number of insurers have increased to 74. Okay, it says that there is more global attraction. Okay, there is an insurance sector of India attracts a lot of FDI. Right. Total insurance premium also tripled. Okay, to 11 to almost close to 12 trillion. So these are some of the facts regarding, you can write for mains. Okay, so life insurance segment is actually the 5th largest in the world. This is also 10th largest. Okay, and it grows at 30 to 34% annually, right? This is a huge growth, right? But the insurance penetration, another important key terminology regarding this, insurance penetration is the total value of insurance premium paid per annum, okay, as a percentage of GDP. As a percentage of GDP, it's very low, okay, 4.2%. Other countries, Western countries, they are in double digits, okay, but we are at 4.2%, which is comparatively very low compared to global standards, okay. LIC is the largest player with 60% market share, right, and non-life insurance is the 14th largest globally, 4th in Asia as well. Okay, so these are some of stats that you just have a general idea about the concept, insurance density and the insurance penetration. Okay, for prelims, the stats are important for mains. Okay, right. So these are the changes brought in by the amendment. It allows FDI up to 100% under the automatic route. Automatic, that is, if a foreign player wants to invest in insurance sector, there is 100% of the investment, right? Whatever it can be, ownership, okay, it can be FDI up to 100%. There is no need for prior approval. Prior approval from government or the RBI is not needed, right? The target is to achieve insurance for all by 2047. So remember 2047. Because sometimes they can ask 2030, sometimes they can ask 2070. Okay, don't get confused. It's 2047. Vikasit Bharat, right? So then another important change is that the criteria for net owned funds for a foreign insurer, for a foreign reinsurer, net owned funds limit was there. That is minimum 5,000 crore was the limit. That has been reduced to 1,000 crore. Okay, so for a foreign insurer to play or take part in India's insurance regime, the net owned funds is the funds that are available to meet all the claims. Okay. It includes the capital, it includes the reserves, the retained profits. Okay, so that pool of funds that should deal with the claims. Okay, the claims on that particular entity. It should be, earlier it was 5,000 crore, but now it is 1,000 crore. That's a change. And transfer of shares. Okay, transfer of shares for insurance companies. If they want to transfer shares, IRDAI approval is required. Earlier it was 1%. If you are transferring shares worth greater than 1% of your paid up capital, you needed IRDAI approval, but that has been changed to 5%. Okay, so up to 5% you do not need any approval for transfer of shares. Okay, of insurance companies. Okay, LIC changes. LIC has been even given more autonomy. It has measures to ensure that it can stay competitive. Okay, there is less need for LIC to go to the government to start offices, branch offices. Okay, so a lot of advantages have been provided for LIC. Okay, then to protect the policyholders education and protection fund has been created. Then insurance cooperative societies that actually engage in insurance amongst themselves. There was actually a limit on foreign participation in such kind of entities. Up to 26% was a cap was there. Okay, 26% of the ownership can only be held by FDI, but that has been omitted. And also the 100 crore minimum paid up capital requirement has also been omitted. Okay, insurance cooperative societies. That is simply cooperative societies, but they actually insure their members. Okay, they pool their funds to protect their members from liability. Okay, so their requirements were also changed. So these are the subtle changes brought in by the amendment. Okay, so this is a sample question for you to try out. With reference to Sabka Bima Subki Raia Act of 2025, which of the following are true? It provides enhanced regulatory powers to the RDI. Okay, that's another important point. IRDAI now gets powers closer to the SEBI. SEBI has powers to seize the wrongdoers' property. It can actually search. It can also disgorge. The profits. Okay, so if any profits have been made due to using dubious means and some wrongdoing was figured out by RDI, they can actually ask them to submit or release that profit. Okay, they can submit that profits. So disgorging the profits. Okay, then IRDA also get powers to impose penalties. Okay, so a lot of IRDA generally I just understand that IRDAI now gets more regulatory powers similar to SEBI. Okay, so that is true. It reduces the net owned fund requirement for foreign reinsurers. This is also correct. It mandates a statutory claim settlement timeline. No. Okay, this is actually wrong. There is no mention of any statutory mandatory statutory timeline for settlement of claims. Right. So if you can eliminate 3, you can immediately reach 1 and 2. Okay. So I hope this question is clear. So generally just understand the objective was to improve the foreign sector participation, but still we do not provide composite licensing. Please understand the various statistics. Please understand the important terms as well. Okay, so that's all on this session on current affairs. Thank you.